Welcome to The Explainer. Today, we're cracking open the 2024 hedge fund playbook. We're going to see exactly where the big money is placing its bets for the year ahead.
So let's just dive right in. With interest rates staying high and risk seemingly everywhere, the billion-dollar question is pretty simple. Where's the smart money actually going? Let's find out. Okay, first things first. We have to get our heads around the new financial climate. The whole era of free money that we got used to over the last decade, yeah, that's over. And if you take away one thing, let it be this. For hedge funds, higher interest rates change absolutely everything. It's a whole new ballgame.
Now, you might think higher rates are bad, but for a lot of these funds, it's actually good news. For one, they just earn more interest on their cash. Simple as that. But the really big deal is that higher rates create more market volatility. And for a hedge fund, volatility is opportunity. It creates a chance to find assets that are mispriced and to generate what they call alpha. Those returns that actually beat the market.
And this new climate is fueling one of the biggest, most important shifts in the entire industry, the rise of what are called pod shops. This is, without a doubt, the most dominant and probably the riskiest trend in finance right now.
So what on earth is a pod shop? Well, think of it like a giant hedge fund that's set up almost like an apartment building for traders. You've got dozens, sometimes hundreds, of individual portfolio managers all under one roof. Each one gets their own little pod of money to manage, and they operate on their own, but all under the firm's super tight, centralized risk management.
And the scale of this trend is just staggering. Look at this chart. The amount of money these platforms manage has absolutely ballooned from $149 billion just 5 years ago to $368 billion today. They now control a record-breaking slice of the entire hedge fund pie. This explosive growth leads to what you could call a paradox. On one hand, you have these huge risks. You get crowding, where everyone is in the same trade, and contagion, where if one highly leveraged fund has to sell, it can trigger a domino effect. But on the other hand, all that herd behavior creates incredible opportunities. See, these pods are so focused on the short term that they can cause major pricing mistakes that a more patient, long-term investor can come in and take advantage of. So that leads us to the next big question. Where do you hunt for that hidden alpha? If all the pod shops are crowded into the same few trades, where are the contrarians finding value? Where's the real white space left in the market? Think about it. Today's markets are really driven by two massive forces. You've got the passive index funds and ETFs on one side, and these hyperactive pod shops on the other. This creates this huge gap right in the middle, which means there's actually way less competition for the old-school, fundamental stock pickers who are willing to do the deep research and hold for a few years.
And this is especially true when it comes to betting against companies, or short selling. As you can see from this data, the amount of short interest in the S&P 500 is hovering near historic lows. Honestly, after getting totally burned by meme stocks and some of these wild rallies, a lot of managers have just thrown in the towel on shorting.
But, and this is a big but, as the source report puts it, this is, quote, creating a rich sea of shorting opportunities that managers can prosecute. In other words, when almost no one is looking for companies that are overvalued, it becomes a whole lot easier for the few skilled short sellers left in the game to find them.
Okay, so besides shorting, where else are managers looking for an edge? Well, here are a few of the key hotspots. First, you've got those totally out-of-favor sectors like biotech and real estate, which are still way, way below their recent peaks. Then there's AI, but people are starting to look beyond the obvious chip makers and into companies that are applying AI in new ways. And finally, there are the unloved equities. Think small-cap stocks and European markets that have really lagged behind the US mega-cap tech giants. All right, let's zoom out and take this strategy global for a second. We're going to do a quick-fire round on Asia, where you have three really different stories playing out in three key markets.
First up, Japan. For decades, this was a market a lot of global investors just kind of ignored. But now, the outlook is way brighter. There are two huge things happening. One, they might finally be ending decades of deflation. And two, the Tokyo Stock Exchange is putting massive pressure on companies to reform, forcing them to actually focus on shareholder returns. And that's unlocking value through things like stock buyback. Next up, India. Managers are getting more and more bullish here for the long haul, and you can see why. You've got this powerful mix of great demographics, a massive young population, plus really strong economic growth. And the big one, companies and investors everywhere are looking to diversify their investments and their supply chains away from China. That just creates this incredibly long runway for growth.
And, well, that brings us to China. Here,
The story is really all about caution. Now, that doesn't mean there aren't opportunities. In fact, controversy can be great for finding mispriced stocks. But with all the economic headwinds, the shaky property sector, and of course the ongoing geopolitical tensions, managers are being way more selective and a whole lot more careful.
So, we've talked about the new interest rate world, the massive rise of the pod shops, and where the contrarians are trying to find value. Let's pull it all together for the one key takeaway for 2024.
If there is one word to describe the year ahead, it is volatility. This chart of 10-year Treasury yields really tells the story. The markets are going to swing wildly on every single piece of economic data as everyone tries to guess what the central banks will do with interest rates. It is just not going to be a smooth ride.
And this is all wrapped up perfectly by this one quote from the report. Navigating a confluence of macroeconomic, geopolitical, and fundamental crosscurrents will be key to success. What does that really mean? It means this isn't a market where a rising tide just lifts all boats. Nope. This is a true stock picker's market, where smart, active management is absolutely critical.
And as always, just a quick reminder, this is not financial advice.